You know that feeling? It's 2 o'clock in the morning. You can't sleep. You're staring at the ceiling fan going around, and you just grab your phone. You don't mean to, you just do it. You open your banking app. You type in the password, maybe you use Face ID, and you stare at the number. For a long time, that number was depressing. It was like $42. It was negative $12 at one point. But tonight, it's different. You finally did it. You scraped together every extra tip, every birthday check. You stopped buying the expensive coffee for a few months. And there it is. You have $6,000 in your savings account. And honestly, for a second, it feels amazing. It feels like you're floating. You feel like, okay, I'm an adult now. I'm safe. If the tire blows out, if I lose my job, if my tooth explodes, I can handle it. It's this warm, heavy blanket of security. But then, just a few days later, you're checking your credit score, or you're looking at a new credit card offer, or maybe you're just trying to get a better rate on something, and you start to realize something weird. You start to feel like the system does not like it. You get these weird offers for high-interest loans. Your bank starts pushing you to move that money into an investment account you don't understand. You feel like you're being treated like a risk, even though you have more money than you've ever had in your life. It makes you wonder, right? It makes you look at the screen and think, is there something wrong with this number? Did I break a rule? My name is Jack, and I spend way too much time thinking about money, financial psychology, and why some people seem to effortlessly build wealth while others stay stuck in the same financial patterns for decades. I've been down to zero, I've been in debt, and I've had that $6,000 cushion, and I've noticed that the moment you start to get a little bit ahead, the world around you, the financial world specifically, starts to treat you differently. It's subtle. It's almost like they can smell the independence on you. And here's the crazy part. That $6,000? It's not just a number to you. To the financial ecosystem, it represents a psychological turning point. It's a line in the sand. And today, we're going to dive deep into why banks get nervous, why algorithms start flagging you, and why that seemingly small pile of cash is actually the most dangerous money you will ever earn. Because once you understand this, once you see the strings they're trying to pull, you're never going to look at your savings account the same way again. You're going to stop playing defense and start playing offense. And trust me, that changes everything. Let's start with the math. I know, nobody wants to talk about math, but just stay with me for a second. In the grand scheme of the global economy, $6,000 is nothing. It's a rounding error. It's the cost of a nice vacation for some people. It's the down payment on a used Honda Civic. It's not retirement money. It's not fire your boss money. So why does it feel so heavy? Why does it feel like it has weight? It's because of what we call the survival threshold. For years, you've been operating in the red zone. Psychologically, when you have less than $1,000 in the bank, your brain is constantly scanning for threats. It's cortisol. It's that low-level hum of anxiety that you get used to, the feeling that if one thing goes wrong, if the dishwasher breaks or you get a speeding ticket, your whole life is going to derail. You're living paycheck to paycheck, not because you want to, but because you have to. You're reactive. The moment you hit $6,000, you cross a threshold. For the first time, probably ever, you have an emergency fund that actually covers a real emergency. We're talking 3 months of expenses for a lot of people, or at least a solid 2. Suddenly, that cortisol starts to drop. You stop scanning for threats as aggressively. You start thinking about the future. But here's the thing about banks. They love you when you're in the red zone. They love you when you're scared. Think about it. If you are living paycheck to paycheck, you are the perfect customer. Why? Because you're predictable. You're going to deposit your paycheck on Friday, and by Sunday, you're going to spend most of it on bills, rent, and debt payments. You're going to carry a balance on your credit card because you had to buy groceries, and that balance is going to generate interest for them. You are a reliable source of revenue. You are a cog in their machine, and the fuel they burn is your financial stress. Now look at you with your $6,000. You aren't panicking. If your car breaks down, you don't need to put the repair on a high-interest credit card. You can write a check. Or, worse for them, you can use a debit card. That means they make 0 interest from your misfortune. They make 0 late fees. You are suddenly boring. Boring is bad for business if your business is selling debt. But it's deeper than just interest payments. It's about data. When you have $6,000 sitting in a savings account, you are holding cash. You are holding liquidity. And liquidity is power. Banks make money by lending out your money that you leave with them. They give you 0.01% interest, and they lend it out as a mortgage at 7%. That spread is how they build their glass skyscrapers. But if you have $6,000, you have options. You aren't forced to keep it there. You could move it to a high-yield online account. You could buy treasury bills. You could dump it into the stock market. You could, this is the scary one for them, pull it out entirely and keep it in a safe. The more cash you have, the more autonomous you become. And the system, the banking system, is designed to capture your capital and keep it moving through their pipelines. When you stop moving, when you start hoarding, you disrupt the flow. You're like a little clog in their river of money. I remember when I first hit this number. I was so proud. I walked into my actual physical branch, something I never do because I wanted to, feel the reality of it. I wanted to talk to a human. I sat down with this guy, let's call him Dave. Dave was wearing a suit that was a little too big for him, and he had that smile that never quite reached his eyes. He pulls up my account. He sees the $5,000, then the $6,000. And he doesn't say, "Good job, Jack. Way to go." He doesn't high-five me. His face drops. Just for a split second. He gets this look of concern, and he immediately goes into this pitch. "Jack, you know that money is losing value to inflation, right? You're basically burning cash by leaving it there. You need to lock this into a CD. Or better yet, let's talk about opening an investment line of credit so you can buy stocks on margin." I'm sitting there thinking, dude, I just managed to save 1 penny of every dollar I made. I'm not trying to buy Amazon on margin. I'm trying to buy a new transmission if my car dies. But he couldn't see it that way. To him, that money wasn't security. It was idle assets. It was money that wasn't making them money. And this brings us to the psychological trap that banks set at this specific level. It's the productivity trap. They want you to feel guilty for saving cash. They use words like inflation and opportunity cost to scare you. They make you feel stupid for keeping money in a low-interest savings account. They want you to rush that money into the market or into a house or into some complex financial product where they can generate fees. Why? Because if you rush, you make mistakes. If you invest that $6,000 because you're afraid of inflation, and then the market drops next week, panic sets in. You sell at the bottom. You lose the principal. Now you're back at zero. And guess who is there to catch you when you fall? The bank. With a credit card. With a personal loan. See how the game works. They don't want you to have $6,000 living paycheck to paycheck because cash is freedom from their products. Why? When you have cash, you're predictable. You don't need their overdraft protection. You're going to deposit your paycheck on Friday. You don't need their payday loans. By Sunday, you don't need to beg most of it on bills, rent, and debt payments. You are self-insured. You're going to carry your balance on your credit card, and that terrifies them. You had to buy groceries. There's a concept in banking called churn. And that balance is going to generate interest. They want your assets to churn. You are a reliable source of revenue. Refinance. You are a cog in their machine. Every time a dollar moves, and the fuel they burn is your financial stress. And they skim a little off the top. Now look at you with your $6,000 sitting still. You aren't panicking. That's dead money to them. If your car breaks down, that's just stubborn. You don't need to put the repair on a high-interest credit card. I think about this a lot when I see those commercials. Or worse for them, you know the ones. You can use a debit card. Don't let your cash sit there. That means they make zero interest from your misfortune. It sounds so logical. They make zero late fees. It sounds like, yeah, I'm a hard worker. My money should be working. Boring is bad for business, but it's a trick. Business is selling because cash is working. But it's deeper than just interest payments. Its job right now isn't to generate 8%. It's about data. When you have $6,000 sitting in a savings account, its job is to absorb the shock of life, so you don't have to go into debt. When you have $6,000, banks make money by lending out your money. It's money that lets you tell bad situations to go away. They give you 0.01% It's money that lets you tell a bad boss to go away. Lend it out as a mortgage at 7%. It's money that lets you tell a predatory lender to go away. That spread is how they build their glass skyscrapers. It's the most powerful $6,000 you will ever have options because it's the foundation. You aren't forced to keep it there. Let's move on to something a bit more technical but super fascinating. You could buy treasury bills, and honestly, you could dump it into the stock market. We need to talk about the scary one for your credit score. Pull it out entirely. Most people think that having money in the bank, the more cash you have, the more autonomous you become. It makes sense, right? And the system, if I have $6,000, is designed to capture your capital. I'm responsible. Keep it moving through. But that's not how the system works. When you stop moving, your credit score is not a measure of how much money you have. You're like a measure of how profitable you are to lenders. I remember when I first hit this distinction. I was so proud.
You have $6,000.
I walked into my
savings,
actual physical
and you
branch.
pay off your credit
something
card
I never
in
do
full every
because I
single
wanted
month.
to. I don't know. Feel
You
the
never
reality
pay a
of
cent
it.
of interest.
I wanted to talk
to
to
a
a human
human
being. I
that
sat
looks
down
like
with this guy.
financial
Let's call him
genius.
Dave.
To the FICO
Dave was wearing a
algorithm,
suit that was a
you're a
little too
deadbeat.
big for him.
That's the actual
and he
term
had
they
that
use in
smile
the
that never
industry.
quite reached
A
his
deadbeat
eyes.
is someone who pays
pulls
their
up my
balance on
account.
time,
He sees the
avoids
$5
fees,
grand and
then
gives
the
the
bank
bank
zero
$0
profit.
And he doesn't say,
Now,
"Good
imagine
job,
you
Jack.
have
Way to
$6,000
go."
in savings.
He doesn't high-five
but you
me.
suddenly stop
His
using
face
your credit
drops,
card
just for a split
using your
second.
debit card.
He
or
gets
cash
this look of
instead.
concern.
Your credit
and he
utilization
immediately goes
drops
into
to
this
zero.
pitch.
Your account
Jack,
becomes
you
dormant.
know that money is
What
losing
happens to
value
your
to
score?
inflation.
It
right?
might stay stagnant.
You're basically
or
burning
sometimes
cash by
weirdly
leaving
it can
there.
dip because the
You need to lock
algorithm
this
wants
into
to see
activity.
activity.
Or
It
better
wants to
yet,
see you playing the
let's
game.
talk about opening
If
an
you have
investment line of
$6,000,
credit,
you
so
might
can buy
decide to
stocks
close a
on
credit
margin.
card you've had
I'm
for
sitting there
years
thinking,
because the annual fee
I
is
just managed to
annoying.
save one
You
penny
think, I
of
don't
every
need this,
dollar
I have
made.
cash.
I'm not
Boom.
trying to buy Amazon
Your
on
average
margin.
age of credit history
I'm trying to buy a new
drops,
transmission
and
if
your
my
score
card's
takes
a
a
hit.
hit.
But
The
banks
banks
get
see it that
nervous
way
because they can
to
no
him,
longer predict
that money
you.
wasn't
When you're
security.
broke, you
It
have
was
to
idle
use credit.
assets.
You have
It
to
was
carry
money
a
that wasn't
balance.
making them money.
You are predictable.
And this brings us
when
to
you
the
have a
psychological
$6,000
trap
cushion,
that banks
you hold
set
all the
at this
cards.
specific level.
You can choose
It's
to
the
opt
productivity
out.
trap.
You can choose
They
to
want you
stop
to feel
using your
guilty for
products.
saving cash.
And from a
They
data
use
modeling
words like
perspective,
inflation and
an
opportunity
autonomous
cost
human
to
is
scare
a
you.
nightmare variable.
They make you feel stupid.
I saw
for
this
keeping
happen with
money
a friend
in a
of mine.
low-interest savings
Let's call her
account.
Sarah.
They want you
Sarah
to
was
rush
a
that
waitress
money
for
into the
years,
market
total
or
hustle.
into a house.
She finally
or into
managed
some
to save up
complex
about
financial
$7
product
grand,
where they can
She was
generate
feeling
fees.
incredible.
Why?
She decided
Because
she wanted
if
to
you
get
rush,
a new
you make
car.
mistakes.
Nothing crazy.
If you invest
just a
that
reliable
$6,000
SUV.
because you're
She
afraid
goes
of
to the
inflation,
dealership,
and then
she
the
has her
market
down
drops
payment
next
ready.
week, she has her
Panic
savings
sets in.
proof.
You sell
She
at the
thinks
bottom.
she's going to get the
You
prime
lose
rate,
the principal.
the 2.9%
Now you're back at zero.
special. They're
And guess who is
advertising
there
on
to
TV.
catch you when you fall?
She sits down.
The bank.
The finance
With a
guy
credit
runs her
card.
credit
With a
and he
personal
comes
loan.
back looking confused.
See how the game works.
He says, "We can get you approved, but it's going to be at 9%. Sarah is floored. She has the money. She has a great job now. She asks why. The guy mumbles something about credit mix and recent account changes. Here's what really happened. Sarah had spent the last 6 months aggressively saving. She stopped using her credit cards entirely to build that emergency fund. Because she wasn't actively carrying a small, manageable balance or showing recent usage, the algorithm flagged her as a credit risk. Not because she couldn't pay, but because she wasn't paying them. They wanted to see that she was still reliant on the revolving door of debt. They wanted to see that she needed them. By saving up that cash, she inadvertently made herself look like she was checking out of the credit system. And the banks punished her for it with a higher interest rate, trying to force her back into the cycle of monthly payments. It's infuriating, honestly. It's like they're saying, you can have savings, but only if you keep playing the debt game. If you stop playing, we penalize you. This is why I tell people, when you hit that $6,000 mark, you have to get strategic. You can't just be good with money, you have to game the system. You might need to put a tank of gas on your credit card and pay it off immediately just to show the algorithm you're still alive. You have to keep your oldest credit card open even if you hate it. You have to stroke the ego of the robot that judges your financial worth. But beyond the algorithms, there's a deeper, more philosophical reason banks get nervous. It's about asset allocation and the velocity of money. In economics, there's this idea that money needs to move. When you spend $1 at the grocery store, that dollar goes to the cashier, who buys a coffee, who pays the barista, who pays rent, etc. That's velocity. The faster money moves, the more the economy grows. At least, that's the theory. Banks are in the business of accelerating velocity. They lend you money so you can buy a house today instead of saving for 20 years. They lend you money for a car so you can drive it today. They are pushing gas into the engine. When you have $6,000 and you decide not to spend it, you are acting as a brake. You are creating friction. You are saying, I am going to wait. I am going to save. I am going to deprive the current economy of my consumption in exchange for future security. This is antithetical to the consumerist mindset that our entire financial system is built upon. We are bombarded with messages telling us to consume. Buy now, pay later. 0% APR for 12 months. No money down. The system is desperate to get that $6,000 out of your pocket and into the hands of a corporation. If you keep it, you're rejecting the narrative. You're saying, my peace of mind is more important than this corporation's quarterly earnings report. And that makes you dangerous. Not dangerous like you're going to rob a bank, but dangerous like a virus in their software. If everyone did what you're doing, if everyone saved 6 months of expenses and stopped using credit cards for frivolous stuff, the entire debt-based economy would screech to a halt. Profits would plummet. Banks would collapse.
They rely on our impatience. They rely on our inability to delay gratification. $6,000 is the ultimate proof that you have conquered impatience. You have looked at the shiny new iPhone, the weekend trip to Vegas, the designer sneakers, and you said, no, I choose me. And that is a power they cannot control. They can manipulate interest rates. They can lobby Congress. They can run ads. But they cannot control your decision to save. Let me take a quick aside here, just because I think it's funny and a little pathetic. Have you ever noticed the layout of a grocery store? Or even better, a Costco? You go in for milk and eggs. You have to walk past the giant TVs. You have to walk past the jewelry. You have to walk past the seasonal decorations. It's the same psychological tactic. The bank is doing the same thing with your account. When you log in, they show you a banner. You're pre-approved for $5,000. Or they highlight a credit card with 3x points on dining. They are trying to distract you. They are trying to tempt you. It's the digital version of the candy aisle at the checkout counter. They know you have the money now. They see the balance. They're thinking, we need to get Jack to click that button. We need to get that $6,000 moving again. When you had no money, they ignored you. You were invisible. The moment you have assets, you are a target. And it feels backwards, doesn't it? You'd think they'd reward you. But instead, they just want to pick your pocket. So what do? How do you navigate this? You've worked hard to get this $6,000. You don't want to hide it under a mattress, but you also don't want to fall for their tricks. First, you need to reframe how you view that money. Stop looking at it as potential spending. Look at it as a soldier. That $6,000 is your private army. Its job is to stand guard at the gate and protect you from the chaos of the world. You don't send your soldiers out to fight a war just for fun. You keep them in the barracks until you need them. Second, you need to make your money boring again. Remember I said banks hate boring? Good. Use that. Move your savings to an online bank that your main bank hates. One that offers 4%, 5%, maybe even a temporary high yield. Move it out of the reach of your debit card. Make it take 2 days to transfer back to your checking account. This creates a psychological wall. It makes it harder to impulse buy. It sends a message to your brain and to the bank that this money is off limits. It's not for buying a new PlayStation. It's not for a spur-of-the-moment concert ticket. It's for survival. Third, ignore the guilt. They're going to try to make you feel guilty about inflation. They're going to try to make you feel like you're losing money. Just ignore it. Yes, mathematically, inflation eats away at the buying power of cash. We all know that. But you know what eats away at buying power faster? High-interest credit card debt, an emergency loan, a broken-down car that prevents you from getting to work. The opportunity cost of not having cash is far higher than the cost of inflation. You are paying a premium for insurance, and that premium is worth every penny. I talk to so many people who get to this stage, they hit the $6,000 mark, and they get antsy. They feel the pressure to do something with it. They want to buy crypto because they saw a TikTok video. They want to flip a house because they watched a YouTube video. They want to invest it in a buddy's business. Don't do it. Seriously, don't. Stay boring. The most exciting thing you can do with that money right now is nothing. Keep it safe. Keep it liquid. Let it sit there and stare at you. Let it be a reminder that you are no longer a victim of your circumstances. There's a quote I love from a guy named Morgan Housel. He wrote The Psychology of Money. He talks about how building wealth has less to do with how smart you are and more to do with how you behave. And the number one behavior that builds wealth is the ability to stick with a plan when things get scary or boring. Saving $6,000 is boring. It's slow. It's tedious. But it's the absolute bedrock of everything else. You cannot build a skyscraper without a foundation, and you cannot build wealth without a cash buffer. The banks know this. That's why they want to dismantle it. They want to shake the foundation, so you have to come to them for bricks. You have to be the one to stand firm. You have to be the one to look at the teller or the loan officer or the pop-up ad on your phone and say, no, I'm good. I want to share one last thought, something that might change how you feel when you check that balance at 2 a.m. When you have $6,000 saved, you are no longer an employee. Not really. I mean, you still go to work, you still have a boss, but you are no longer a hostage. Let me explain. If you live paycheck to paycheck, your boss owns you. You cannot speak up. You cannot quit. You cannot ask for a raise because you're terrified of losing the job. You have to smile when you want to scream. You have to work weekends when you want to see your kids. Because the alternative, missing a paycheck, is catastrophe. Now take the same scenario, but you have $6,000 in the bank. Your boss is being unreasonable. He's yelling at you for something that isn't your fault. He's demanding you work late on a Friday night. In the past, you'd take it. But now a little thought pops into your head. A tiny, rebellious thought. I could walk. You might not do it. You might need the job. But just knowing that you could survive for 2 months without a paycheck changes everything. It changes your posture. It changes your tone of voice. It changes your confidence. You can stand up straighter. You can negotiate. That $6,000 is a fuck you fund. It's a small slice of freedom. The banks know this too. They know that when people have savings, they become harder to manage. They become less pliable. A workforce with savings is a workforce that demands better wages and better conditions. A population with savings is a population that isn't desperate for predatory loans. So, when they try to convince you to move that money, to spend that money, to borrow against that money, just remember what they're really trying to do. They're trying to take away your freedom. They're trying to put the handcuffs back on. I'm not saying banks are evil. They are institutions. They are machines designed to maximize profit. You can't blame a shark for eating a seal. That's what sharks do. And banks are designed to feed on financial inefficiency and desperation. By saving $6,000, you are removing yourself from the food chain. You are making yourself inedible to the shark. And that makes the shark nervous. So, if you're watching this and you have $6,000 saved, or even if you're just starting to save your first 100, take a moment to appreciate what you're doing. It's not just math. It's not just numbers on a screen. It's a revolution. It's a quiet, personal revolution against a system that wants you to stay small, stay scared, and stay dependent. You are building a shield. You are building a fortress. And yes, the bank might get a little nervous. The credit card offers might get a little weirder. The algorithms might get a little confused. Let them be nervous. Let them be confused. You just focus on you. Keep stacking.